Hi, I'm Tim Quast with Market Structure Edge, and it is October 16th, 2025. Let me get rid of that. And with me, as usual, as often is the case anyway, is the brains of the outfit, Brian Wilson, our market strategist. And today, Brian will go first, and I will bat cleanup or whatever you do. Yeah, so over to you, Brian. Thank you.
Sounds good. Sounds good. Welcome everyone. Great to see you all. Hope you're doing well. Hope your trading is doing well as well. Obviously, an uptick to volatility, and we'll kind of walk through what we're seeing. By the way, if you've never been here, this is from Rocky Mountain National Park, outside of Estes Park. Unbelievably beautiful. You'll often see the elk just right there in the park. We've seen them a couple of times just on camping trips. They'll just come right into where you're camping, but great location. Well, I wanted to start my discussion in a familiar place, and sometimes it's good to be familiar because you kind of get to know the dynamics of the market when we do the same thing over and over again. What I'm going to briefly discuss today is just alignment. I like to check alignment between the broad market and between big tech. Big tech being 30 to 35% of market cap. Are they aligned right now? Are they moving in a similar direction? If we look at what is happening with big tech, this is this is S&P 500. Here in green is what we call broad market sentiment. That's our algorithm for demand. It has just started to move lower. It's right now down to 5.3. Tim, when was the last time that we were below neutral? It's been a long time, hasn't it? It's got to go back at least 6 weeks, but we've been quite a stretch above neutral. We probably get below neutral in the next couple of days. And we'll talk about that, but down to 5.3, short volume rising. So I mentioned this in today's note. This is what we call convergence. When we have declining demand and rising short volume, it tends to either produce gains or produce losses or contribute to losses in the broad market. We're seeing that playing out today. So broad market sentiment in a state of convergence, sentiment approaching neutral. If we look at big tech, slightly better positioning. It's currently at 5.6, so there's still a little ways there to get below neutral. Now, of course, big tech, it includes the usual suspects. It also has AMD, Netflix, and Shopify in there, so that can skew that just a little bit. If we look at the usual suspects are actually already below neutral. So if we look at the Magnificent Seven, those are down to 4.5. So that it's already weakened there. There's that state of convergence, declining demand, and increasing short volume. If you talk about alignment right now, we would say they're probably both aligned, and they're both aligned either below neutral or making their way below neutral. I did want to circle back to a period back in February, March, April timeframe, and I want to just show you behind the scenes what's happening in the data when we start to see weakness. So if we look at this February period and once again, this was expirations, inflection point, declines afterwards, declines in the early part of April. What was happening in the data as we were going through that stretch? So this is broad market, and this is big tech. And if you look at that period, and I was on vacation for about a week here, so I missed just a little bit of it, but you can see that generally we were right around that neutral level. And then as we moved into March, we can see that big tech had really deteriorated, broad market not for a little while. But you know, you can see those conditions stretching for a pretty long period of time. You know, we went through much of March in those conditions, and still until we started to recover a little bit. You know, what was happening from a broad market perspective during that stretch? You know, what were the returns? We had returns of -4%. So once again, we were aligned with the broad market and big tech, generally below neutral for most of that time, and not surprisingly, the broad market suffered. If we look at April, you know, when we started to deteriorate, and look at how rapidly this occurred. This was obviously the tariff drama back on the third market, down 5%. We were down another 6% the next day. But look at how rapidly those numbers went lower from a big tech perspective. Whole market weaker. And just as a reminder, it's a good reminder for all of us. You know, you can get those periods of weakness. You know, look at that snapback rally there on the 9th. And periods of volatility can go both directions. You know, you get extreme volatility to the downside, you get those snapback rallies. We saw that on Monday. You know, we were lower on Friday, we got a snapback rally on Monday, and kind of back and forth we go. But if you look at that period where everything was weaker, you know, even with those 9% advances, what was the market? You know, we were down 6%. So just keep in mind, we're not there right now. I think we're approaching that point, but you know, just keep in mind what potentially happens when we do have that type of weakness. I did mention this morning VIX expirations, and let me show you what this looks like. So just go to the website, Market Structure Edge, and go to our resources tab if you ever want to look at it. We try to keep you up to date on these items, but you'll see it right here, the planning calendar. And this is I'll call it a gap, and it occurs every 3 months. This is the normal rhythm where green is VIX expirations. That's regular expirations Thursday and Friday. You can see how October is different. We're just getting started with expirations today, which will conclude tomorrow, but we don't have VIX expirations until next Wednesday. So what has happened year to date when we have that type of cycle? It occurred here in January. There's regular expirations. The market rallied then into VIX expirations, and then kind of retreated afterwards. Didn't do much of anything. If we fast forward to May, market was higher into expirations. It went lower into VIX expirations, and then rallied afterwards. So you see these inflection points, you know, higher, lower, higher again. We look at August. Market higher into August expirations. Once again, it retreated afterwards, and then we once again caught a bid. Now, these are not apples to apples comparisons. If we look at sentiment back here, sentiment had been rising. It's not the case right now. If we look back in May, this was our extended rally. Sentiment was well above the red line. Overbought or stretched conditions. If we look back in August, once again, sentiment rising. So it is a little bit of an apples to oranges comparison. But the point here is that even when tomorrow concludes, we're not out of kind of the expirations time frame yet. We really won't get a clear look at the market until we move into the middle of next week. Did want to share with you a couple of other items, then I'll turn it over to Tim. One is right here with our momentum and our low volatility portfolios. So on average, and I went back, I've been keeping this data for the last couple of years or so. I don't have every single day, but most of the trading days. On average, we have 11 names in momentum. On average, we have 15 names in low volatility. And you can see that over time. You can really tell when we're in the middle of a momentum market. And once again, momentum tends to be about 11 names. Look at September trading. How the whole stretch of September, we were well above that average in terms of momentum. What's the market going to do? Well, it's generally going to be better in that type of environment. What are we starting to do now? Well, those momentum names are starting to decline. Once again, with low volatility, look at all the options in low volatility there during September trading. Once again, those options starting to decline right now. It's very hard to find. I think Tim, it's what 2.1, 2.2% for those low volatility names. It's just hard to find those at this particular time, and those options are starting to dwindle.
The last 2.2%. I think 2.2. We use basically use the 200-day average of the S&P 500 is the idea there.
Yep, perfect. And the last topic I'll touch on is I have a couple of short portfolios. The one is named after our friend Barry. It touches the kind of the high end of sentiment. So when sentiment starts to fade, think of the high flyers that have been up at 9s and 10s, and they start to retreat below 9, but they have high short volume. That's the Barry short portfolio. My short portfolio is when sentiment starts to fall below 4. And for both of these portfolios year to date, Barry's averages 19 names, mine averages 17 names. And when you look at periods of high volatility, like early April, it was incredible. Just a ton of names in those portfolios. Starting to track a little bit higher right now in both of those portfolios. Let me catch up to where we're at. So the last couple of days, once again, in the Barry portfolio, the average is 19. You can see we're starting to track higher there. Mine is 17, starting to track higher there as well. So we're losing options in both our momentum and low volatility portfolios. The potential for shorting is increasing. You can see some of the handwriting on the wall. And Tim, with that, I'll turn it over to you.
Sorry. Okay. Thank you, Brian. Appreciate that. Okay, so I've only got 2 things that I want to spend time covering here, and our aim is to help you. So, that's certainly what we're trying to do here. We want to try to help you avoid risk in the markets and take advantage of the opportunity for returns. So the first thing on my list of items, to a very short list, is volatility. There are 3 big things that matter to us. We always talk about broad sentiment, context, and divergence. Yes, I think those are just understanding how the market works and what the money is doing. That you have to have a big picture view of what the money is doing. Most of the market cap. In fact, I'll shamelessly plug. I'm supposed to. In fact, I just traded notes with his producer, but I'm supposed to be on with Brian Sullivan on CNBC in the 2 to 3 p.m. Eastern time block tomorrow, and some of this is what I'm going to talk about. At least that's my intention. That you have to understand how the market works. Why is it? How come is it that the Dow could be up 400 points and then you turn around and you come back to your screen, it's down 170? What's responsible for that? Why is stuff like that occurring? Is that rational human behavior doing it? Well, no, it's not. But it's why we talk about understanding what the money is doing, and then what is occurring in the market. There's a cadence and calendar. Every day you don't start over at go. There are patterns of behavior that change. It would be impossible for BlackRock, which reported results this week and said and updated, they'll update their AUM, $13.5 trillion of assets under management, a big chunk of that in U.S. equities, for that money to be able to move in a day. It can't happen. It's why small caps struggle. You say, well, they're at a record. Well, back out inflation and you're losing money in small caps. They're just back above where they were in 2021. And the reason is there isn't enough size. You could go create a small cap portfolio at Edge, dump it, and tally the market cap. It's $2.5 trillion. There are 8 stocks in the market with more market cap than the entire Russell 2000, right? So these are things that you have to understand. Why would you buy the Russell 2000 when you could buy NVIDIA, which is twice as large? Nearly, not quite, but you follow me here, right? So these are things to understand about the market. But what I mean here is we trade demand, supply, and volatility, the other big three. That's why those things matter. And when there is no volatility, it's very easy to make consistent returns. When volatility returns, which it inevitably will, I think the last time I was on with Brian Sullivan was a while ago. So I said then that I thought, based on the patterns of behavior, exactly what we see with individual companies. It's earnings season, and we have scores of public companies that we support with quantitative data. This is what we see, that if you have volatility events, you can count on 2 quarters of mismatches versus your peers or your sector. Why? Well, most of the money follows models. And so if we have a 2 quarters of trouble in the markets that started with the December 18 Fed decision, that then culminated in the April tariff tantrum, and then we were off to the races. What is the probability that 2 quarters forward we could have trouble? Well, mathematically very high, because it's how the market works, which is why I said so. I think it was April 28th. I said to Brian Sullivan, I think there will be a second shoe toward the end of the 3rd quarter or early in the 4th quarter. And it's because of the way that volatility behaves in the market and the way that money that follows models behaves. I mean, you're going to have to reweight your model at some point. If you have had tremendous returns in part of it, and you are BlackRock, and you have pumped out whatever it is, 2,000 prospectuses for various funds, you're going to have to do what those prospectuses say, which means you're going to have to square your models. And when will that happen? Probably 2 quarters out, right? So that's a pretty good rule of thumb, and we use it all the time. So then that's the first thing. That is what the money is doing. Most of the money is not doing what everybody thinks it's doing, which is picking stocks. It's not. I've mentioned this before. Go look at the Growth Fund of America from Capital Group, largest actively managed mutual fund. And its number 5 or 6 position is cash. Why would you, if you're running $300 billion of money, have as one of your largest holdings cash? Because people are selling your fund. That's why. You have to hold cash to meet redemptions, which means every opportunity you get, you're a seller. You're the opposite of BlackRock, which has tens of billions of dollars every month to deploy into equity and fixed income funds. And where is it going to go? Well, it's not going into the Russell 2000. I'm sorry. It's going into there are now 11 stocks with $1 trillion of market cap. Guess what the weighted average market cap of the Wilshire 5000 index is? $1 trillion. Guess what the weighted average market cap of the Wilshire large cap index is? $1 trillion. Right? So that's where the money's going to go. And there are 2 right behind. You look at Walmart and Salesforce, and they're 860, thereabouts 870. So that's where the money goes. Now, here's part 2, volatility. So we look at demand and supply. Brian spent a bunch of time talking about that. We look at it everywhere. I just sent a note to the folks at State Street who run what's called transition management. If you decide to shift, if you're CalPERS, so the big public pension plan in California, and let's say you've had Invesco running your money and you decide to shift it to BlackRock. There are lots of big portfolios then that have to be bought and sold. Well, there are big banks that run that. One of the players is State Street. And it happens to me way, way down the scale. I have my own transitions from, like we move money from this thing or that, and it vexes me how badly those things are executed. It's like, does no thought go into this process? Do you just buy and sell stuff randomly? And I look at the returns and I go, how could you botch it that badly that I would lose 5% of the assets in the process of moving it? And this is why we talk about the stuff we do. If you can avoid doing things like that, you will succeed. I mean, just look at the model portfolios, which I'll talk about secondly. They're not perfect, but they work. Understanding demand, supply, and volatility work. And so getting back to my central point, when BlackRock is moving money, it is trying to track benchmarks. And the threat to that is volatility. It gets much harder to track your benchmark if suddenly we go from 70 basis points of volatility in SPY, a State Street instrument, but BlackRock has one too, IVV. Vanguard has one, VOO. They all behave very similarly. And all of a sudden now it's 1.4% and you're moving hundreds of billions of dollars. This is a problem. And who's setting those prices? Well, it's not BlackRock, it's Citadel. So you put the whole thing together and you have demand, supply, volatility. You have the relationship between what is the money doing? It's trying to follow a model. It's buying products, not stories. You could listen to CNBC all day long and they're like, they have this alert. Somebody so-and-so just reported results, That's not what BlackRock's buying. BlackRock is buying a product called hundreds of billions of dollars of equities that have limited volatility. And when that breaks down, all of a sudden the machines like Citadel, Susquehanna, Jane Street, Virtu, Optiver, Tower Research, on and on it goes, who are setting the prices, suddenly can't do it well. The models, they're running it all automated, right? Yes, I'm going to do that, Anesh. I will talk about, Anesh said, are you going to talk about the second portfolio? Yes, I will. And I'm sorry, we sort of snuck that in. We'll call that a soft launch. I decided we should have a second choice there. That's what's happening. When you see these prices moving all over, that's not people reacting. That's like algorithms that don't know, based on the inputs that are all of a sudden twice as volatile as they were a week ago, how to price things. That's what's happening. And that's why we look at it and we tell you those things. We go, whoa, there was a volatility event. If you are risk averse, go to the sideline, yank your money, put it in cash and wait. Right? That's always the safest option. And people will say, well, you can't time the market. If you try to time the market and you miss the 5 best days of performance, you will never catch up. Well, that's crap. You absolutely can time the market, and you should be aware of demand supply imbalances. If you're just trying to do it with no knowledge of what the mechanics of the market are and what the money is doing, then it's likely to be a fool's errand. But we can absolutely see those conditions. And so that is what's occurring. And notice where it occurs. It's not perfect, but it's occurring into options expirations. Today are index options expirations. Cash settled at noon Eastern time. What did the market just do? Just plunged. I don't know what it's doing at the moment, but I looked over and everything was up 40 basis points. And then I looked over and it's all down 90 basis points. And you think, well, what in the world? Must be something that Donald Trump said to Vladimir Putin. No, that's not how the market works. That is not how the market works. So anyway, that's why we watch these things. If you're trading volatility, which we do, right? I'm going to share my screen. It's an essential concept if you want to protect yourself. Once you know how these things work, it gets a lot easier. But if you know in daily trading ideas what the volatility of something is, like APLD has been, it's been a good trade. You can very consistently, if that thing's down, if it's in this portfolio and it's down 7%, you're going to make money on it, right? It's got 14% volatility. The problem is if you buy APLD and you have a limit or a stop down 2%, it's not going to work. You're going to get stopped out. And how would you know? Because you know how volatile it is. Look at those. It's crazy, the volatility in here. So you have to have some real stomach for risk. But if you know the demand supply imbalance, what happens tomorrow is what matters. We that's why we have this advantage where I could say, no matter what, you could look at the market, the futures are up 250 basis points, and we're telling you, no, that's not what the data indicate. The data indicate demand and supply are converging. Demand is working its way toward neutral, could turn negative. On a daily read, it has. It's 4.6, still rounds to 5. Supply has risen back over 50%. Well, what is the probability ahead that that will put pressure on equities, all other things being equal? Very high mathematically. It's the stuff we calculate. So it does not matter what the market is doing at the moment if the math tell us that what it's likely to do is something else. So volatility, very important. And when you're trading positions, this is why we always say take your gains. If you get your 2, 3, 4, 8%, if it's up all of its volatility, get out. You've exhausted the range. You may need to get another shot at it, but it is the essential ingredient, and it's because machines set the prices. And the machines are setting prices for money that wants the midpoint, somewhere in between, because it's tracking a benchmark. And those things have gotten very, very difficult to calculate here. That's why I think this could become a big problem. I don't know that it will. We don't know. I'm just saying the conditions are right for it. Okay, so that leads me around to this.
Tim, can you hold that screen for 1 second? Chris had a thought on Mara, which is on the screen. Just checking on that Marathon one because it's in it's in the momentum list. You can see, Chris, that volatility is 11.6%. As I check it right now, it's down about 10.6%. So I mean, personally, I might look at that one towards the close. It's down most of its volatility. So certainly have some potential there.
Right. And you would, the risk is you would have to hold it over the weekend. Now, I do that routinely. I don't love to do it when demand and supply are converging, because there are two problems with it right now. Broad sentiment is converging. And let's go look at the crypto portfolio too. Which, you can create one, and options are expiring. New options trade on Monday. Monday could be I'm not saying, you could say, Quast, you're always this cynic. Well, I'm wired to think about, well, what could happen? It's so I look at the demand supply balance and it's a risk, but all other things being equal, the probability that if you bought it at the reference price into the close, market on close, that you could make several percentage points come Monday, very high, right? It's very high because you know how much that price moves. So to reinforce your point there, Brian, here's the risk. If you look at that, so you always want to look at the bigger picture. So if you look at crypto stocks, what are they doing? Well, it's not bad. Demand remains very strong. It is clearly peaked. If you were going to get out of this stuff, that's where you would get out, right? About October 10th or 11th, right? About when it crashed, right? You would have a tell. So you'd already have a tell back here. You'd go, well, okay, they bottomed. We've got very good demand. Supply's rising. We know what that means. Their stock is being created to fill orders. This is in stocks of cryptocurrency companies, but it's a good indication. And then you have this dramatic move on the supply side. And it started, well, maybe so there's what happened. On the 10th, look at that dramatic shorting that occurred there. I don't know if it would have protected you or not, and given that day, but you can see it plain as day what happened. That has also been covered, and it's out of the way. Does this then present a lot? Well, demand is starting to decline, but you'd look at this and say, well, that trade might be okay. If you're putting the data together to try to stack the odds of a good outcome in your favor, and you will not find that, in my opinion, in a chart. I don't understand how people can look at a chart, because those are prices set randomly by machines, which are trying to price the bid and the offer and cross the spread between them and make money. That's what they're doing. Would I rely on that as a tool for investment decisions? No, those are investment horizons of 400 million milliseconds. Why would I depend on that? But demand supply imbalances, these have longer range application. And I'll give you a case in point here, and then I'll go to the model portfolios. If you looked at this, if speaking of a chart, let's just do 6 months. I mean, if you looked at the price, it's almost doesn't even, let me go back up because there's not enough variance. Okay, that's too close, zoomed in too much. Let's try 3 months. What I'm trying to say is, could you look at this price behavior and tell what would happen next? I don't know how you do that on any given stock. I know you draw lines and you're like the double top or a double bottom and whatever the terms for technical signals are. Look, if they work for you, more power to you. I just look at it and say, I know what creates those. And I would look at this and say, you have no idea on the basis of this price graph, whether the market is going to go up or down. What will tell you? Well, generally speaking, demand and supply will tell us. It's not perfect, but it's a much better indicator of what's coming. Otherwise, how would you know? Moving to the model portfolios, for instance, this is the momentum portfolio. Look, it's still great. I mean, it's up 43%, something like that. Is this an indicator? I don't know. That's not how I think about it. Clearly, this behavior of the portfolio is similar to this behavior. This was longer. It was a longer top that led into a decline here. Is this going to do that? Well, I have no idea. How could you couldn't, the only thing you could do is run the data and to me depend on the demand supply balance to tell you. I mean, clearly this is different from this and everything that it's done where we've had this tremendous momentum. Clearly that's run out. Now, maybe it takes off again. But I don't know how one could use price to arrive at a conclusion. That's why it's so comforting to just let a model do that. Just tell you every day, okay, what are we going to do? What are we going to own? That's what this math does for us. It just says, okay, here's your portfolio and get rid of that stuff and buy this stuff. And you say, well, why does that work? Because it's using things that give us a higher probability. Let's see. Last thing I want to talk about is, Anesh, to your point, the second portfolio. So we added this, we call it the low volatility. It's a focused low volatility portfolio. There is a little kicker in there that can only happen if nothing else is found in the criteria. But it's looking for stuff with 3% or less. That's higher than the low volatility portfolio that you have on the dashboard, but it's designed to find stuff at 5 with limited volatility that they're very it's stable stuff. We have a much bigger portfolio, 35 components that we call the buy fives portfolio that we run internally. It's not being used right now. It's up about 21%. This is up 46%, I think it is. I mean, it's way up. Yeah, 46%. But look what it owns. You go, well, isn't that? I mean, it's what it's finding, right? Whatever it finds that meets the criteria, it will prioritize by market cap. So it's naturally going to end up with those things. You say, well, that's the same as everybody else owns. At the moment, it's true. The moment that deteriorates, though, it's going to find something else. And it's it's purely quantitative. So what's the difference between them and why is the return similar? The entry and the exit. These exit when here are the two criteria. It's when the sentiment trend turns negative or the supply demand divergence turns negative. Meaning if we're buying fives and this begins to happen, it's going to get rid of it. Or if this happens to the demand side, it's going to get rid of it. And it's going to go look for something that meets the criteria of stable, low volatility fives, because it only buys fives. It's just buying sentiment that equals 5. Intraday volatility of less than 3%, large cap, so the market cap range is greater than 20 billion. That's it. There's the kicker. We could look for a supply demand divergence. If none of those are found, I don't think it even plays a role in the outcome. It's in the event that there's some kind of market event, then we would want to find supply demand divergence. So, but that's, they work and they're simple. So I've become a big fan of these. I'm busy and sometimes I can't watch stuff, and this just permits me at any time. I mean, as I've said before, sometimes I'm trading outside market hours. I just adjust the positions. I'm out at the moment. I am not in the more model portfolio because volatility has doubled. Oh, that reminds me. I wanted to spend one quick moment looking at SPY, and then we'll stop. Um, the volatility in SPY has doubled in basically the last 6 trading days. And so with those conditions, I prefer, we're in options expirations, demand supply in the broad market is converging. I'm just going to wait out the other side of that. I just prefer it. I have a volatility trade today because I thought, well, it could be volatile, right? I've had those. There are times at inflection points where I will use those, and they don't always work. I've lost money on those. They're harder to do, and I've made enormous sums on them. They're just higher risk things to do, and I'm not recommending it. So here's the thing with SPY. The question to me about it, and the reason it matters is because this is what the money's doing. SPY is a reflection of BlackRock, Vanguard, State Street. This is where all the money is going. And the reason it spends a lot of time at 5 is because the money is in large cap blend equities, value and growth stuff at 5. And so, when will this deteriorate? That's what you watch for the long periods at 5. And at some point that's going to end. Well, what would cause that to end? A slowdown in demand would cause that. And could that happen here? If we had, I looked at the math and I said, if we had another bad day, if we had another day like Friday, this would break down below 5. So, will that happen in the next, could it be today? Could it be Monday, Tuesday, Wednesday, or VIX expirations Thursday? So there's high risk to Brian and me from today through Thursday. Thursday will be out of VIX expirations. We get there and everything's improved, we're fine. And I'm back in the model portfolio. But if something's going to go wrong here, it's probably in this number of days. And it's because of, again, ending where I began, broad sentiment, context, divergences. We're moving toward convergences. And then you think about demand, supply, and volatility. Volatility's way up. So we'll see. That's all I've got. Anything to answer? Yeah.
Yeah, Tim, if I can share my screen for a second, I'll just show everyone one thing here with the model portfolio. So this morning is a good example. The email goes out, and if you're interested in that low volatility portfolio, when you pull up the email, it will look something like this. So you can just click on the momentum portfolio, or you can just click on that low volatility. You click on low volatility, it's exactly what you've been seeing here. So you can see there's the components, there. So it looks exactly the same, and you can just choose which route you want to go, if that makes sense.
Chris says, what time do you make your buys and sells? It's kind of random for me. It's not like using the daily trading ideas. Using those, I prefer under, if the conditions permit, I like to buy late in the day, last 10 minutes, because I'm going to get the reference price, the BlackRock price. Just using like Kleenex. I'm using BlackRock like Kleenex. It's like a type, like I use Citadel. And then you're looking for the exit, the exit range. That's the aim. Oh, and if you can get, what the volatility is, if you can get more, fine, you can take it, but you always after, can I get 2%? With these, it doesn't matter to me. What we found mathematically is, since your time frame is different, this is a long range, even though we're rebalancing it as much as the math says, this is a long-term investment strategy. Yeah, short-term trading tactics to produce yield, long-term strategy to outperform, to do better than any other choice. That's what you're after. And you have to significantly outperform to cover the costs of trading and so on. So that's how, and look, sometimes I like the trading outside market hours because it's so easy to do. I use interactive brokers. And so long as I'm willing to take the limit, like if the posted price is going to be it, whatever's showing up, we don't really know, but the last price will be here, and I'm just willing to take what that price is. I can fill trades pretty easily, but at Root, I don't really care. It's wherever I can fit them in. And you say, well, that makes you, isn't that cognitively dissonant? No, not in this instance, because the model has already qualified it. I already know this is the stuff that I want, and now it's just a matter of getting it done.
Tim, one question from Anesh regarding the entry range for Mara today. If perhaps you could just spend one moment on that.
Let's see. What is it? Let's go have a look at that.
It's down, 50% of volatility. So it would be below today's entry range. And that's all that's talking about, Anesh.
Oh, I gotcha. Yeah. Is it outside the entry range? It's a good point. And it's if it's more than the volatility, I'd be careful. And you say, well, what? If it's 11.7%? No, what I mean is, if we're down 12, 14%, I might avoid that because it's occurring with options expirations, and it may tell us that there's money. I don't know. There's clearly some element, the equity or its derivative is getting repriced. But if it's down all of its volatility, things look okay in cryptocurrencies. There's always some risk, but I'd feel like that would be okay. That's how I think about it. We had this. I remember having the conversation with Steve Hicks, whom some of you will know. Long time he's not using Edge at the moment because he went back to photography, but smart guy and thoughtful about the use of the data. He concluded too that if something is all at the outside its volatility, it could throw the math off. So just beware of that. This is
Tim,
so
can I share my screen for 1 second here? And Anesh, I'll speak into part of what Tim was just discussing. So if you look at this will give you the calculation. So this is where that's coming from. So the entry range is down 50% to up 30% of volatility. So right now, Mara would be below that range, but to Tim's point, it's not down all of its volatility at this particular time. So hopefully that makes sense.
And the reason we arrived there, just to follow that really quickly, is what we're trying to do is create a high probability of a return. So we know something moves this much, and we know that the demand supply balance is like this, then what's the probability of capturing a piece of that? If it's down half the volatility, or you buy it even up a third of its volatility, do you still have a probability of producing a return? Well, mathematically in the models, and we ran all kinds of computations on that, and it consistently returned. And we tested, well, what if your stop was set here and here and here? How consistently would it deliver returns? And that's what you see in the probability. Where we have algorithms that are calculating that all the time and looking for those things, and it just worked. So mathematically, it makes sense. Okay, well, let's see. Anything else?
Candace, I'll take your question for a second. Candace's question is: is the focus momentum in low volatility, are they longer term strategies? Yes, generally speaking. I started trading them when we cranked everything up. Sometimes you'll hold a position for a week. Sometimes you'll hold a position for a day. It just depends whether it hits the exit criteria or not. But if you have a good position that we can let it run. And that's one of the beauties, some of those positions were yielding, 10 to 15% on the upside because they weren't hitting the exit criteria. So
Right.
it just depends whether or not it continues to be in that dynamic or not.
And I'll answer. Was it Anesh? Was that your question? I think so. And Candace, just to follow on it, we had a really nice note from a user who said this was Monday, or it was last Monday. He said, I didn't know if, he's using the momentum. He was using the model portfolio. He said, I don't chase the stock price, so I haven't purchased 100% of the recommendations. And depending on market direction, I may add stops or trailing stops, he said. But 8 weeks in, he said, I'm thinking, well, I don't have the same result as the model portfolio because it's going to have to be yesterday. I mean, we can't do it real time because we have a demand supply equation. So then if it exits something, it got yesterday's close. So how do you know you're going to get a price that's comparable? Mathematically, you do. Once again, that played out in the model. And he said, my results to date for 8 weeks have been 10.3% returns. Initially, it didn't seem like I was doing as well as your model, but realistically, with time, trusting the data, I gained confidence. The data and the results that you've provided have shown a remarkable return. I mean, it was a really nice comment, but he's disciplined. He's a pretty sizable trader, and it works. It's worked for me too. I don't really worry about that's the difference, Candace, where, with daily trading ideas, we're being very disciplined about entries and exits. With this, it's about letting the math create a longer term strategy that you don't have to watch. That's the idea. Yeah. Anesh, VOO versus SPY. Tomato. They're all huge. IVV, VOO, SPY. SPY is easy. It's in the data. They're the same. I mean, if you run a chart on them, they're like 99% correlated. So I'm not really worried. I think we'll stick to it. Edge momentum, 5 symbols, edge level. Well, they should both be. The only difference in those portfolios, and the only reason why the portfolio has 7 instead of 5 is because it's kept them. It's sort of a mathematical anomaly. They're both designed to be five component portfolios. I mean, that's what we call them focus. It's like they're designed for you and me. Like we're not going to buy 25 things. Could we buy 5 things that will give us good returns? Smaller number, higher risk, and yet it's worked pretty well. So they're both designed that way. The one difference is I think one has could turn over 4, and the other one could turn. I think the low volatility is set to only turn over 3. Like if the mass said sell everything, it would still only sell 3 of them. It would keep a minimum bound. And so, we don't want to find ourselves selling our whole port. Maybe it should. I mean, we could set that. It would tell you when to be out, but I think it would increase the turnover too. And I think, Anesh, that was your idea to try reducing the turnover, which we did. That's what we did. We just said, okay, keep at least this many, and that cuts down on the turnover. And it actually improved the returns. So yeah, worked. Okay, we kept you long. Good to see you. Go enjoy the day. That's what I'm going to do. I've got everything done. Beautiful day. I mean, we tend to be, I wasn't today, but I'm usually up at like 3:45, 4 o'clock. So now it's a beautiful day. And we're headed out into it. I suggest you do the same. Enjoy. See you guys. Have a great weekend.